Imagine standing at the top of a snow-laden hill. You start a small snowball rolling. As it descends, it keeps getting larger, picking up more snow at every turn. Think of that snowball as your dividend earnings. With each roll, the dividends accumulate, growing your wealth in a fantastic cycle. Stick around, and by the end, you'll learn how to harness the strategies to potentially net $5,000 monthly. Welcome to Dividend and Conquer, your source for financial empowerment. In this video, we'll talk about how to build a powerful dividend snowball. Let's dive in. When we talk about investments, remember that everyone's journey is distinct. You might have aspirations of a modest $1,000 monthly or a more ambitious $5,000. Whatever your goal, it's crucial to understand the tools at your disposal. One such tool, the Dividend Snowball Effect. When a company you've invested in shares its profits via dividends, and you use this to buy more shares, guess what happens? The number of shares you possess increases, which means the next time dividends are distributed, you get a bigger piece of the pie. It's like Warren Buffett wisely said, "Someone's sitting in the shade today because someone planted a tree long ago." So plant your financial seeds today, nourish them with patience, and watch them flourish. So let's play with numbers. Assume a span of 25 years. In one strategy, you make a single $1,000 investment. In another, you consistently chip in $200 monthly. Taking a real-world example, let's delve into a company named AbbVie. Adam, for example, our financial enthusiast, absolutely loves AbbVie. It's a company that has consistently raised its dividends for the past 9 years. Modeling its performance forward, AbbVie's compounded annual dividend growth rate is an impressive 14.53%. Now, with a singular $1,000 investment in AbbVie, fast forward 25 years, and with dividends reinvested, your humble investment swells to an astonishing $29,715. On the flip side, without reinvesting those dividends, you'd have just $4,632. That's the magic of the dividend snowball. If you've been enjoying this journey so far, do us a favor and hit that subscribe button. Become a part of the Dividend and Conquer community, and let's grow together. Let's explore a bolder scenario. Adam goes big and invests $10,000 up front. After 25 years, that investment magnifies to a staggering $297,153, yielding annual dividends of $37,698. Yes, that's $3,140 per month, a sum most would cherish post-retirement. The allure of dividend reinvestment becomes more evident when we stretch the timeline. In 35 years, with just $200 invested monthly, you'd amass a fortune worth over $2.1 million, raking in a monthly dividend of over $22,500. Now the burning question, where should you park your money? Here at Dividend and Conquer, we've curated an elite list spanning various sectors that promise safety with rewarding returns. Consider the dividend aristocrats, stalwarts like Coca-Cola, Procter & Gamble, Johnson & Johnson, and McDonald's. These are behemoths with a history of consistent dividend growth. Thinking of broader horizons, dive into high-dividend ETFs like the SPDR-S and P Dividend ETF, Vanguard High Dividend Yield ETF, or Schwab US Dividend Equity ETF. For those with a penchant for real estate, explore dividend-generating REITs. Kimco Realty Corp., Brandywine Realty Trust, and Brookfield Property REIT are just some titans in this realm. What's imperative is recognizing companies with unique competitive advantages, ensuring they remain relevant, grow, and compound wealth over time. This enormous growth demonstrates the strength of diversifying across different dividend-bearing assets. Now, let's break down why these investments are so potent and how viewers like you can implement these strategies effectively. The science behind dividend investing. You see, dividends are more than just a bonus payout for investors. They're a sign of a company's financial health. When businesses consistently pay out dividends, they're sending a message. We're stable, we're profitable, and we believe in sharing those profits with our investors. Historical perspective. Historically, companies that consistently pay dividends have been associated with mature, established firms that manage their finances well. These are the giants of industry. Think about brands that have been household names for decades, if not centuries. Their business models have been tested through the boom and bust cycles of the economy. The steady nature of these enterprises makes them less susceptible to volatile market swings, providing a cushion during economic downturns. Embracing modern stocks. Now, that doesn't mean that all dividend-paying stocks are from old-school sectors. Modern tech companies, once known for reinvesting every penny back into growth, are starting to recognize the importance of dividends. Take Apple, for example, which began offering dividends in 2012. The shift marked a significant transformation in the company's strategy and showed a commitment to rewarding shareholders. Diversifying with ETFs and reits. While individual stocks are great, remember the saying, don't put all your eggs in one basket. That's where ETFs and reits come into play. These funds pool together various stocks or real estate assets, providing instant diversification with a single purchase. This spreads out risk and allows investors to tap into the potential of multiple assets simultaneously. Understanding reits better. Let's delve a bit deeper into reits. As mentioned, these are like mutual funds but for real estate. Why is this crucial? Well, real estate as an asset class historically provides inflation protection. As prices rise, so does the value of land and buildings. By earning dividends from reits, not only do you gain from the property appreciation, but you also earn a share from the rental income these properties generate. The global landscape. Now, while we've largely discussed the U.S. market, it's essential to recognize the global landscape. Dividend investing isn't restricted to America. Many international companies offer attractive dividends. Exploring stocks from Europe, Asia, or even emerging markets can provide additional layers of diversification and yield. Just ensure you're aware of the foreign tax implications and currency risks. Reinvesting, the golden goose. To truly conquer the world of dividends, there's one strategy that stands tall: reinvesting. Instead of pocketing those dividends, consider using them to buy more shares. Over time, this strategy can lead to an exponential increase in your holdings without investing additional capital. The power of compound interest is on full display here, and it's how many savvy investors build significant wealth over the decades. Bonus tips: always keep an eye on dividend payout ratios. It's a measure of how much of a company's earnings are paid out as dividends. Ideally, a ratio below 80% suggests the company retains enough profits for growth while still rewarding investors. With this in mind, you'll not only chase yields, but also ensure long-term stability. All right, Dividend and Conquer fam, always remember that investing is a journey. The key is consistency, research, and patience. Like that snowball, start small, stay consistent, and let the magic of compounding work wonders. What are your thoughts on dividend payout ratios? Do you have any personal experiences or tips to share? Drop a comment below and let's foster a community of knowledge sharing. Stay invested and let those dividends flow. Thank you for joining us on Dividend and Conquer today. Remember, financial empowerment is just a click away. Hit that subscribe button, ring the notification bell, and let's conquer your financial goals together. Don't forget to share this video with your friends and family. Until next time, invest wisely and prosper.